So, hello guys. Today we talk about trend identification, support, and resistance, right? So, this is part of what we call technical analysis, right? Now, in the previous session, we had talked about fundamental analysis. And fundamental analysis is the concept behind just analyzing news events and then taking trades based on news events, right? So we expect a news event from America, from the US economy that that has to do with employment. So we call it non-farm payroll. So when that data comes out, it could be positive, it could be negative, and when it's positive, it affects the economy positively, right? So we trade in that direction. If it's negative, it affects the economy negatively, and therefore the US dollar negatively, and also we trade in that direction. That's fundamental, right? So for this is technical analysis. This has to do with the study of the charts, chart analysis, right? Chart analysis. This is what we do here, right? Now, first of all, we start with trend identification. What is trend identification? So in the markets, the financial markets, we say that the trend is your friend. The trend is your friend. And the reason the trend is your friend is because you want to trade in the direction of the trend. And trading in the direction of the trend is gotten from the concept of following the money. In the market, in this financial market, there are those who move the markets, there are those who follow the money. There are market makers, there are market movers. Now, for you to move market in the financial market, in forex market, for you to move the market, you need billions of dollars. You need to buy a particular currency with literally billions of dollars. Or you need to sell into a particular currency, make sell orders worth billions of dollars. That's when you can move the market. But any other person who doesn't possess those funds, which is basically like 99% of the population, will only make money by following the money. So what we want to do with the market is we want to see where the money is flowing. We want to see where that big money is flowing, where that 10, 20, 30, 50 billion dollars is flowing, $100 billion is flowing. If that's flowing towards the sell direction, what we'll be looking for is looking for sell. If that's flowing towards the buy direction, what we'll be looking for is buy trades mainly. So if the market is selling, if $100 billion is selling, if $100 billion is selling the market, or 10, 20, 30, 50 billion dollars is selling the market, and you that has $10,000 in your account, you want to buy, that is the equivalent of standing in front of a train, a high-speed train that has cement loaded on it or has stones loaded on it. You can imagine how heavy that is with all that speed, and you as an individual, you're trying to stand in front of it and stop it. How are you going to do that? It's not going to, you can't do that, right? You can't do that. So what you want to do is that you don't want to stop that kind of movement. You don't want to stop that train. You don't want to force that train to grind to a halt. What you want to do is you want to go in the direction that train is going. You want to hop on that train and let the train carry you to where it's going. This is the reason why some people will look at the market, they'll think like, oh, the market should start buying from here. Meanwhile, the market is selling. It's a downtrend. If it's a downtrend, why are you looking for sell opportunities? If it's a downtrend, why are you looking for buy opportunities? Why do you want to buy in a downtrend? Why not look for easier trades, which is basically sell opportunities? When you look for sell opportunities in a downtrend, your life is easy. It's easier to make money. When you look for buy opportunities and uptrend, your life is easy because it's easier to make money, right? So that's the concept behind trend identification. The trend is your friend. So the first thing you want to do in the market is you want to decide what is it you want to trade, what instrument, what currency, what asset do you want to trade. Once you identify the asset you want to trade, the next thing you want to find out is what is the trend of this asset? Where is it going? Where is it going? Is it selling? Because there are several types of trends. You want to identify the trend, the predominant trend of that current asset. the predominant trend of that current asset. So I'll write out a few things on the screen just to explain this to us, right? So there are three types of trends. There are three types of trends. Number one, we call the uptrend. Number one, we call the uptrend. Number two, we call the downtrend. Number three, we call the sideways trend. Sideways trend. We also call it the range. We also call it range. We also call it consolidation. Consolidation. We also call it consolidation. Sometimes it's even called a no trend. No trend, right? So these are the three types of trends. Now, really, ideally, when you are in an uptrend, you are looking mainly for buy trades, mainly for buy trades, mainly buy trades, mainly buy trades. Now, it doesn't mean that there are only buy opportunities in an uptrend. There are still sell opportunities that arise in an uptrend. But your predominant direction, the main trades you're looking for, the trades that will give you the best opportunities, the trades that will give you the best moves in the market are buy trades. The trades that will give you better profits, easier trades, rest of mind are buy trades. Okay? Then in an uptrend, in a downtrend, we are looking mainly for sell trades, mainly for sell trades. Now, in a downtrend too, there are usually buy trades. You can find opportunities for buy trades, but those buy trades are usually pullbacks and retracements. Pullbacks and retracements. So those are not the kind of moves you want to be entering. Those are not the kinds of buy trades you should be looking for. In a downtrend, you're looking predominantly for sell trades. But when you find buy trades, you use those buy trades as your time to wait, analyze the market more, and then look for opportunities to re-enter sell trades. That's what you're looking for in a downtrend, right? Then in a no trend, let's remove the no trend. This was okay. Sideways or range or consolidation. So in a sideways or range or consolidation, what you're waiting for mostly, what we do mostly is we wait for a breakout. 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 That's what we do mainly in the sideways trend. Because in a sideways trend, just like one of the names suggests, there is a no trend. Now, if you are in a situation, we'll explain it not too long from now in this class. If you're in a situation where there is no clear trend, we said the trend is your friend. Now, in this case, you can't find a trend. What do you do when you can't find a trend? Remember, the market is always entering buy trends, sell trends, up trends, down trends. But there are times where the market will not be in any trend. It will be in a consolidation, in a range. It's more like in a waiting period. So what if the market is waiting, what should you be doing? You should be probably waiting as well. You see? Sometimes it is just the impatience. Traders have the impatience to just wait. And then certain times it comes from certain targets for yourself. Like you tell yourself, I must make so and so amount of money every day. Or I must make so and so amount of trades every day. You know, all of those things. When you give yourself those targets, you put pressure on yourself. And then when you see a consolidation, instead of you to hold on, wait for it to do what you expect it to do, which is wait for a breakout, you tend to want to jump on that trade. And many times it doesn't go well. Okay? Because at that time you are waiting for price to break below. If it breaks below, you know that you are selling. If it breaks above, you know that you are buying. If you start buying and then it breaks below, it means that you are going to be in a significant loss. See, so that's the reason why it's advisable that once you're in a sideways or a consolidation, sideways trend or a consolidation, your best move at that time is to wait for a breakout, right? So let's explain a bit of these trends. Let's understand them a little bit. What does it mean when we say we have an uptrend? What does it mean when we say we have an uptrend, right? Let's try to explain that. Okay. So usually when you see a market move that's like this, when you see a market move that's like this, you can see with your eyes that the market is going up. But then, as a trader, as someone who understands the market, you are not just using your eye you're not only trying to see the direction the market is going, you're also trying to find entry positions, because first of all, you want to identify the trend. Once you have identified the trend, what is the purpose of identifying trends? You want to be able to use the trends that you have identified. You want to be able to take advantage of the trend that you have identified. So if you are going to take advantage of the trend that you have identified, you are going to have to identify entry points along the trend. You're going to have to identify entry points along the trend. That's the reason why we analyze it and we say we are identifying trends. Normally, when you come on the chart and you zoom the charts in, once you zoom the chart in enough, you can see, anybody can clearly see that this is an uptrend or this is a downtrend. You can see it clearly. But that's not what we do in trading, just seeing the trend. No, that's not what we do. We want entry positions. First of all, I want to see where the trend is going. I want to see that this is a buy trend, or this is an uptrend, or this is a downtrend. Once I've identified that, the next thing I want to do is find positions of entry. Since I know that I am mostly going to be looking for buy trades in an uptrend, what I want to do next is find entry positions. I can see that I'm supposed to be buying. So where do I enter my buy trades? And then when I enter my buy trade, how do I manage my risk? Where is my stop loss going to be? Where is my take profit going to be? Where is my target profit going to be? How am I going to manage what kind of risk to reward ratio am I going to have? Where is my stop loss going to be? Where is my take profit going to be? Right. Okay, that's what this is. So when you look at this right now, you see that this is like a chart. This is a chart right now. This is not a real chart, a simulated chart. Now this is a chart. Now below here, just below here is what we call the lows. This is the lows. Bottom here, anywhere here to the inside part of the chart, to the inner part of the chart is what we call the lows. The lows, the inner parts of the chart is what we call the lows. The lows. The lows, right? The outer part of our chart is what we call the highs. We call that the highs. The outer part of the chart, we call them the highs. High. Okay. So the outer part of the chart we call the highs. The inner part of the chart we call the lows, right? Now, when you look at the highs and the lows here, when you look at the highs and the lows here, you want to identify what is going on here. So something to take note of with uptrends is that an uptrend has a series of high highs and higher lows. So let's explain what that means before we even talk about it. Now, look at these stops here. Look at this. These are what we call high points. High points. These high points are also called swing highs. Swing highs. So we are talking about the highs now. So the tops here, the outer part of the chart is called the highs, while the lower part of the chart are called the lows, right? Now, when all these points where price reverse, where more like an inflection point for price when they're reversed, when they're pulled back, it's more like something is attacking price when it gets there, right? It's more like something is attacking the price when price gets there. Something attacks price when price gets there, right? Look at it. It looks as if something attacks price when price gets there. So it seems to recoil. So price hits this point, recoils. Price hits this point, recoils. Price hits this point, recoils. Price hits that point, recoil. Like that. These areas are what we call the swing highs. We call them the highs. We call them the highs, or we call them the swing highs. Okay? Now remember, the outer part of the chart is said it's called the high. The high, generally high. The lower parts, the lows. Okay? Now, but these areas here where price seems to hit and recoil, we call those the swing highs. Swing highs. So you can see how the market plays out. It's playing out more like a swing, up and down, like an oscillation, oscillatory kind of movement, right? So we have this as the highs, then we have this as the lows. This area here where price seemed to get to and also recoiled. Price got there and pushed back. Price got here, pushed back, got here, pushed back, got here, pushed back, got here, pushed back, right? So these now are what we call this the high, we call this the lows. Now, this is a high point here. This is a high point. And why is it a high point? It's a high point because we are dealing with highs. This is a swing high here. This is a swing high. We are dealing with the highs. So by dealing with the highs, this is what we call swing highs. Now this is the high. Okay, call it a high, call it a swing high, doesn't matter. Call these lows, you call them lows or you call them swing lows, it's fine, right? So we have a high here, right? Now this high, if you notice, this high is higher than this high, just in terms of positioning, right? This is not, there's no magic around this. This is just in terms of positioning. When you look at this and you move up, this is a higher high, which means this is a high that's higher than this. So we call this a higher high, HH. Higher high. Higher high. That's a higher high. So that's a high that's higher than the previous high. This also, when you look at this, this is higher than the previous high. This is a new high, and it's higher than the previous high. We call that a higher high as well. We call that a higher high as well. So that's a higher high too, right? That's a higher high as well. Why? Because this high is higher than the previous high. That's all, period. The same thing goes with this one. We have a higher high here as well, because this high is higher than the previous high. No big deal, it's as simple as that. Then here you have lows, right? You have lows here. The bottoms here are called the lows. They're called the swing lows, or they're called the lows, right? Now, around this place, this is what we call a low. Just pick a point here. The first point here we call a low. First point here we call that a low. The first point here we call it a low. Then you notice this low here, remember the bottoms here, everything here we call the lows, right? Now, the low point here, this low here, which is a swing low, this low is higher than this low, just in terms of position. In terms of position. So when you move from here to here, it looks as if you are climbing. So because of that, we say this is a higher low because this low is higher than this low. They are both lows. All of these are lows. The both tops are highs. The four of these points now are also lows. They are called swing lows. But then this low here is higher than this low. So we call it a higher low. Higher low. Right? Higher low. Also, this low is higher than this. We call the higher low. Call the higher low. Then with the higher low. Then also we have this here as a higher low. Why? Because the low is higher than this low. Higher low. Okay, so you see an uptrend is a series of higher highs and higher lows. An uptrend is a series of higher highs and higher lows. That's an uptrend, right? Okay, so what is a downtrend? This is for uptrends. This is an uptrend. Then for a downtrend, let's look at this. So when you look at this, just look at it, you will see that it seems as if price is trending down. Like we said earlier too, we are not just looking to see a direction in the market. That's a good thing. That's the first thing we want to see. We want to see a direction, but that's not the only thing we're looking for. We are also looking for entry points. Entry points. Now, in an uptrend, these areas of lower or higher lows are our entry point. Remember, we said we are looking predominantly for buy trades. These areas are what we call our entries. Entries. This area, the lows is where we enter. Entry, 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 entry. These are entry. All right, so these are entries. These areas here are entries. This is where we are entering the trade. This is where we are looking to enter our trades, right? So now that's the 10th thing. We're in an uptrend. We're looking for buy trades, and the areas where we're looking to enter are the lows, the lows here. These are the higher lows. These higher lows is our entry for a buy trade. Once we're able to identify these areas, these higher lows, we are able to enter those points to get into our trades for a buy. Okay. All right, so now let's go to downtrends. Now for a downtrend, we are looking mainly for sell trades. That's what we said. We're looking mainly for sell trades, right? But first of all, let's look at it. Let's analyze this downtrend very well. Now, the same thing happens here. The tops here are called the highs. Highs. So the tops here are called the highs. Sorry about this. It's not very clear. So the tops here are called the highs. Then the bottoms here are called the lows. Low. So the tops here are called the highs, the bottom here are called the lows. So here, we'll pick a point, we'll pick any point here. But these points here are also swing highs. These are what we call swing highs also. Swing highs. Why? Because they are on the high. They are on the side of the high. They are on the part of the high. They are in the part where we call the highs. They are called the swing highs. Now, these are called swing lows. Why? Because they are on the low part. They are on the low part, the inner part of the chart. These are called the swing lows. Swing lows right here. So we have the highs, we have the lows. So we can call these highs, or we can call them swing highs. We can call these lows, or we can call them swing lows. Whichever one, right? Okay. Now, this point here is a high. Is a high. But when you look at this high, all of these are highs. By the time you look at this high, in terms of positioning, you notice that this high is lower than the previous high, which means this one is higher than this one. So this now, because this is lower than the previous one, we call it a lower high. Lower high. We call it a lower high. Because this high too is lower than this, we call it a lower high. Lower high. Same thing here, we have a lower high. Lower high. The bottoms here are called the lows. So the first one here we'll say is a low. Then we see that the lows here are lower. As they come down, they are lower. They are lower than their previous ones. So we call this a lower low. Lower low. Then we call this a lower low again because it's lower than the previous low. And we call this lower low because it's lower than the previous low. We call this lower low because it's lower than the previous low. So what you see here is that you are seeing that a downtrend, this is a downtrend now. So a downtrend now is therefore a series of lower highs and lower lows. So we're saying lower highs. Can you see this? Lower highs, then lower lows. So a series of higher highs and a series of higher highs and lower, a series of lower highs and lower lows is what we call the downtrend. A series of lower highs and lower lows is what we call the downtrend. So now this is different from us trying to identify. This is different from us here trying to look at this trend from the perspective of someone who doesn't know the market. Like I said, if you come to any chart, zoom it in, you will see that you can see the trend with your eyes. But that doesn't mean you can trade it. So what we are doing is we are looking to analyze that downtrend that we can already see with our eyes in order to use it to trade. So for an uptrend, for a downtrend, we said we are looking primarily for sell trades. We are looking mainly for sell trades. There are also buy trades, but we are looking more for sell trades because sell trades will give us better opportunities, lower risk, higher reward. That's what we're looking for. And what will give us that is sell trades in a downtrend. Okay, so for entries now, where your entries will be around the lower highs. The lower highs will present us the entries that we need in order to enter our sell positions. The lower highs, right? The lower highs will present us the opportunity we need in order to enter our trades, right? So this is an uptrend, this is an up, this is an up, this is an uptrend, this is a downtrend, okay? So the third one is what we call a no trend, a no trend, a no trend. So a no trend or a sideways trend is a trend that is not that clear. So there is no real trend there. There's no real trend there. So you see that price sometimes, most times in this case, you will notice that price will do something like this. So you will notice that price will do something like this. This is what you're going to be seeing in a consolidation. You see something very, very similar to this. So the question is, where is price going to? Where is it coming from? Where is price going to? Where is it coming from? So in this case, this is the reason why we say we advise that you are patient, because you want to make sure that you wait for price to break out. You want to make sure that we wait for price to break out. When price breaks out, then that's when your trade opportunity is going to be. If price breaks out to the top, that's a buy trade. That means buy opportunity activated. If price breaks out to the upside, buy opportunities activated. If price breaks out to the downside, sell opportunities activated. You see? So, but then if price is within this ranging position, I'll call it a range, right? Call it the range, we call it consolidation. Now, if price is within this area now, how do you know where price is supposed to go? How do you know? You really don't know. If you're thinking that price is going to buy, you don't know. It's more like you are preempting the market. And it is smart, it's wise to not preempt the market, rather wait for the market to give you a clear direction, a clear move, then you can then react to that move. So it's best to allow the market give you a clearer move, then you can then react to that move. So when the market is not giving you clarity, many times we feel like we must trade. We must trade, I must trade, I must trade. Yes, you must trade. Now, but you don't trade. But you don't trade when the market is not giving you clarity. You don't trade when the market is not giving you clarity. If the market is not giving you clarity, then what are you going to trade? What are you using to trade? Right? What are you using to trade? So you want to be able to let the market give you a clear picture of what you are doing or where you are going. Then you can then be confident in your trade. That's when you can be confident in your trade. When we see price break out of here now, we know price is going to buy. Our risk on that trade becomes reduced and our reward on that trade becomes really maximized, will really increase because we can see clearly. But until this breakout happens, I really don't know what price is going to go. If I think I know, the only way I might know is if I'm monitoring the price from some other position. I'm using multiple time frames. Maybe I'm looking at this from a lower time frame, but I'm looking at I'm doing my analysis looking at a higher time frame. I'm able to see that okay, I know that price is going to break out from here. I am pretty sure price is going to break out from here because I can see that price has been doing certain things before. I have a projection for price, so I can think that price is going to do this, break out from here. But if I'm not doing any other analysis and all I'm doing is just come to this chart, look at my trend, get into this chart, and I'm seeing that this is the kind of trend I'm seeing, the smartest thing for me to do will be to wait for this breakout to happen. Sometimes you might wait for a day, you might wait for more than a day. Depending on the time frame you're on, you can wait. But once you get that, when that trade does what you want, it breaks out, gets to where you expect it to get to, it will give you the profit, and you can then decide, you can then say to yourself, oh, it was worth it for me to have waited, right? So also here is where we bring in the concept of support and resistance, right? So support and resistance is a situation where price is stuck within a certain range, where the uppermost range is what we call a resistance. A resistance is what we call the upper range. We call the upper range a resistance. Call the upper range a resistance. We call the lower point a support. We call the upper range a resistance. We call the lower range a support, right? The top bar here, we call it resistance. The below bar here, we call it a support, right? So now the thing is, this support and resistance come from the concept of a roof and a floor. A roof and a floor. Now, wherever you are right now, listening to me, you are currently sitting on the floor, or you're sitting on a chair or something that is sitting on the floor. Doesn't mean you're sitting on the bare floor. It means that you're sitting on something that is sitting on the chair. You are sitting on something. It could be a chair, it could be a stool, it could be whatever. You are sitting on something that is sitting on the floor. So there's a floor there. Then above you now, somehow, above you now, there is a roof, no matter what it is. Now, if you take a ball, like a volleyball or a tennis ball, a lawn tennis ball bounces very well. You take that lawn tennis ball and you smash it on the floor. Think about it. It's either you do it or you think about it. Of course, whether you do it or not, this is something that you know. When you take that ball, you smash it on the ground very heavily, that ball is likely to go up, hit the roof, then come back to the floor, then go back to the roof, and continue like that until the momentum dies out. Until the momentum dies out. So it goes up, comes down, goes up, comes down, like that. So that floor where it's bouncing from is what we call a support. This is very akin, very, very similar to what price does in the financial market. So this is similar to what price does. So that area there where price is, that bottom area where price is bouncing from, I mean this area now, this bottom area where price is bouncing from is what we call a support. This top area where price is bouncing from also is what we call a resistance, right? So what happens is that price will bounce to and fro a resistance, meaning that when price gets to the roof here, which is a resistance, this is where buy trades usually happen. So it is better to buy at a resistance. It is better to buy at a support, sorry. It's better to buy at a support and sell at a resistance. It's better to buy at a support and sell at a resistance. I know some people will be like, but you said you shouldn't buy at in a range, in a consolidation, right? In a support, in this sideways trend or a consolidation. Now, you don't necessarily need to buy or sell within a consolidation like this. But what I'm talking about support and resistance now is a concept, the concept of support and resistance and how you can use it to trade. Because the point is this, even this support and resistance you are seeing here right now, you are going to use it, you are still going to, even though generally this is a sideways trend. Now, sideways trends usually occurs sometimes within an uptrend or within a downtrend. So if you are in a downtrend already, sideways trend happens. It is either that when price breaks out of that downtrend, that sideways trend, it continues downwards or it continues upwards, right? So it's important to understand the concept of support and resistance and how we can trade with it, right? Now, when you are a resistance, that is where price usually sells. That's where price usually comes down from. When you are the support, that's when price usually goes up from. So the idea is to buy from the support where you expect the price to rise, or sell from the resistance where you expect the price to come down. Okay? So now, when price gets to, after price bounces up and down within the support and resistance like this for a while, what will happen is that price will usually break out. So price will usually break out. When it breaks out to the top, that means buy opportunities activated. When it breaks out to the top, it means buy opportunities activated. Okay? Now, when it breaks out to the bottom here, it means sell opportunities activated. When it breaks to this bottom, it means sell opportunities activated. So the best opportunity basically within an uptrend or a down, within a support and resistance, we said for a resistance, you should be selling when price gets to a roof or a resistance. You should be buying when price gets to a support or a floor. That's the concept behind it. But after price bumps up and down for a while, price will tend to break out of the resistance. And when price breaks out of the resistance, that means price broke to the top. It means that you are looking for buy opportunities. Market is telling you, hey, buy. But before that buy happens, you will notice that the resistance will become a support. Price will turn a resistance to a support before moving up. Price will turn a resistance to a support before moving up. So then also, when price breaks out of a support, price will turn that support to a resistance before coming down. Let me say that again. When price breaks out of a resistance, price will turn that resistance to a support, and then price will rise from there, will move from there. This is what we call a breakout. So we call this a breakout, a pullback, and a continuation. So price will break out, pull back, and continue. Break out, pull back, and continue. That's where all of this comes from. All this movement up and down here. That's where it comes from. Is a breakout, is a push up. We call it an impulse. So price will make impulse, pull back, continuation. Impulse, pull back, continuation. So this breakout is usually an impulse. An impulse is a situation where price makes a significant move in one direction in a short period of time. You can see that sometimes you see that there are several multiple candles, 2, 3, 4 candles that are moving all in one direction. That's what you call an impulse. Sometimes it can be one long candle. Sometimes it can be multiple long candles, multiple candles in one direction. That's an impulse. You know, so you have an impulse, breakout, you have a pullback, you have a continuation. You have an impulse breakout, you have a pullback, you have a continuation. All right. So now whenever price breaks to the top, we say we're looking for buy. When price breaks to the bottom, we say we're looking for sell. Okay. So I'm going to close this class here so that it's not too long. We have other things to discuss around this as we progress. Okay.